Alexander Green, The Gone Fishin Portfolio, Get Wise, Get Wealthy, and Get On With Your Life, Agora series. Embark on the path to financial independence with the Gone Fishin Portfolio, a Nobel Prize-winning strategy. In this book summary, Alexander Green showcases an approach to asset allocation that has proven to be successful in managing significant portfolios. By constructing a portfolio of uncorrelated assets, you can master uncertainty and generate excellent investment results. In this app, you will learn the importance of being smart, understanding that no one knows the perfect asset allocation pattern, and why you should not rely on the government. Discover key principles such as discipline, skepticism, and savings. Green explains how to maintain a long-term investment approach and balances risk through mutual funds.
Mastering uncertainty. Discover the principles for financial independence and learn how to take control of your financial future with the Gone Fishin Portfolio strategy. This approach to asset allocation, developed by Nobel Prize winners Merton Miller, William Sharpe, and Harry Markowitz, emphasizes the importance of constructing a portfolio of uncorrelated assets to generate maximum investment results. Don't rely on others to manage your money, take charge of your finances to ensure long-term stability and success. Social Security may help with retirement, but it won't be enough. The current system is unsustainable, and other options like corporate pension plans are not guaranteed. It's essential to save and make smart choices with your investments. Avoid taking unnecessary risks and seek objective facts rather than trusting others driven by commissions or fees. It all starts with having a clear, specific vision and realistic expectations for where you want to go financially. Master the uncertainty with the Gone Fishin Portfolio strategy and take control of your financial independence. Building fiscal rigor. Building fiscal rigor is not an easy task, but with discipline and a set of useful tips, it can be achieved. To be financially independent, you need to develop a savings mindset so that you can invest. Many people fail to save enough because they lack discipline and do not track their expenses. To build fiscal rigor, you need to start keeping a record of what you spend and update it daily, identifying areas where you can cut costs. Saving as much as you can is also essential, especially when your employer offers a matching contribution to your savings. You should always educate yourself about investing and focus on effective rather than flashy strategies. Don't try to keep up with the Joneses, as spending like your peers can hinder your progress towards financial independence. Finally, stick to your strategy by writing down your plan and goals, and post them where you'll see them regularly. By following these 5 tips, you can develop fiscal rigor and set yourself on the path towards financial independence. Wall Street's exploitative sales culture. Wall Street may be a leading sales machine, but it prioritizes profit over customer wealth. Despite the numerous experts and indicators used to predict market changes, the investment sage Peter Lynch warned that these methods are often futile. Lynch's advice highlights the reality that Wall Street cannot be trusted with your money. Embrace humility in investing. Accepting the unpredictability of the future is crucial when making investments. The most successful investors don't attempt to predict the market. Trying to time the market is akin to gambling and is not a reliable way to secure one's financial future. It's essential to recognize one's limitations and be skeptical. Investing in common stocks. Don't risk outliving your savings, invest in common stocks. Investing in common stocks is an ideal way to build wealth for the future. Despite being riskier than T-bills, they have always provided higher returns than those guaranteed to be safe. Even in the Great Depression, common stocks had better returns than T-bills, as they have through every phase of the business cycle. Stocks are, in fact, a much safer investment because they help you avoid the risk of outliving your savings. Although stocks are volatile, their risks can be managed, making them an excellent investment option to ensure your financial stability in the long run. Advantages of Vanguard mutual funds. The Gone Fishin Portfolio by Alexander Green suggests investing in Vanguard mutual funds due to several benefits. Firstly, Mutual funds allow for easy diversification, are professionally managed, require low minimum investments, and do not need financial advisors. Additionally, liquidating or reinvesting funds is stress-free, with reliable customer service. The book advises passive index funds, which over time outperform actively managed ones, despite market unpredictability. Wall Street profits from high-fee mutual funds, but Vanguard mitigates this risk by offering low-cost Admiral shares to long-term or large investors, resulting in lower rates by up to 5 times compared to other fund companies. Invest for the future. To maximize your investment returns, strategically allocate your assets in a portfolio that balances risks and returns. Determine your financial goals and allocate your holdings accordingly, investing in assets that counterbalance one another. Decide if you are a trader or an investor and develop a long-term plan to achieve financial success. Consider 6 key elements, including savings, time for investments to compound, asset mix, return on assets, expenses, and taxes. Rebalance your portfolio periodically to maintain appropriate asset proportions. Avoid investing too conservatively or taking excessive risks, and do not delegate your financial future. Are you looking to maximize your investment returns and secure your financial future? One critical choice as an investor is determining how to allocate your assets, or rather, what mix of investments to purchase. The goal is to create a portfolio that strategically allocates your holdings in assets that do not move in lockstep with one another, making them uncorrelated. Doing so will counterbalance the movements of each asset, reducing volatility without sacrificing returns. Before investing, determine whether you are a trader or an investor. A trader makes money through short-term market moves, while an investor develops a long-term plan and sticks with it. Your portfolio's long-term performance depends on 6 critical elements. First, the more you save and invest, the greater wealth you stand to build. Second, the more time your investments have to compound, the more wealth they create. Third is the asset mix. Your portfolio should comprise assets that do not move in lockstep with one another. For example, common stocks offer attractive returns over the long term, but they are often quite volatile. By blending stocks with other assets, such as bonds, real estate investment trusts, REITs, and gold shares, you can dampen volatility without sacrificing returns. Fourth is the return on assets. You cannot predict or control how your investments will perform. It's essential to balance risk and return. You can minimize expenses by avoiding investment advisors or brokers' fees. Fifth, savvy tax management can save you thousands of dollars over time. And lastly, reevaluating your investments required taxes to maintain some proportionality. Once you have determined your portfolio's asset allocation, periodically rebalance it to bring asset proportions back to the appropriate level. Doing so imposes discipline and will require you to sell and buy assets at the right times, preventing you from loading up on cyclical winners or dumping cyclical losers. Invest prudently, avoid investing too conservatively, or taking excessive risks. Never delegate your financial future to brokers, insurance agents, or financial planners because you're their client and not their priority. In closing, the best way to build wealth is to save and invest with discipline, and time is your most precious resource. Choose wisely, and enjoy the rewards of financial success. Tax-saving tips for smart investors. Don't let taxes eat up your investment returns. According to research, the average investor loses 2% of their returns to taxes. But you can legally reduce your U.S. income tax liability by taking some precautions. Invest in tax-deferred retirement accounts for high-tax exposure assets. Keep tax-efficient investments in taxable accounts and opt for stock index funds. When rebalancing, consider the tax implications and wait 18 months between changes to significantly reduce your tax burden. By following these tips, you can maximize your investment returns by keeping more of your hard-earned money. ETFs versus mutual funds. ETFs have lower expenses and tax efficiency but have drawbacks like the cost of buying and selling and inability to reinvest dividends. Vanguard funds are better for most people, but ETFs may benefit some investors with low transaction charges and minimum investment thresholds. In the world of investment, both exchange-traded funds, ETFs, and no-load mutual funds are highly popular choices. However, the former may have advantages over the latter, boasting lower expenses and better tax efficiency, among other factors. Despite their benefits, ETFs do present some drawbacks, including the cost associated with buying and selling, as well as the inability to reinvest dividends automatically. That being said, some investors may find ETFs more useful, particularly those with insignificant transaction charges and lower minimum investment requirements. Nonetheless, for most people, Vanguard funds would still be the better option. Achieving financial independence. Discipline and goal setting for retirement planning. To attain financial security in retirement, setting clear goals and exercising discipline is crucial. According to the book, withdrawing a conservative 4% annually from your portfolio will minimize the risk of shortfall. However, to achieve this, one needs to accumulate substantial amounts of savings. For example, someone aiming for $50,000 a year requires a nest egg of at least $1.25 million. Discipline is key, and it's essential to plan your expenses and trim unnecessary ones to achieve your objectives. The book emphasizes that living the high life now could have severe consequences. Financial planning and restraint are necessary for long-term independence.
The Gone Fishin Portfolio offers a strategic way of achieving financial independence with prudent risk-taking and long-term planning. Understanding the limits of your knowledge, starting from being smart and adopting a disciplined approach to savings, investing, and sticking to your financial strategy separates you from your peers. Mutual funds provide a solid foundation for managing these investments and avoiding common errors such as excessive conservatism, excessive risk-taking, market timing, and imprudent delegation. Through a well-balanced portfolio, staying vigilant about taxes, and periodic rebalancing, this investment approach sets you up for a secure financial future.